So yesterday we saw that we had this big decline on the 10-minute chart of the S&P 500 yesterday, right? So again, this was a big drop. Initially, the markets were gapping up because we saw the Federal Reserve a little bit more dovish. We had Meta earnings out there. And then all of a sudden, number one, look at where we were, trend line. Trend line. Let me show you this, guys. This is pretty crazy stuff. Go to your daily chart. Look at where we opened on the day. This is why charts blow my mind. This is why charts get me so freaking excited after 20, 25 years of doing this, is because you still open up there, everything looks rosy. Fed is dovish, Meta earnings were showing great results. In general, we saw Google earnings were good. Markets still open up on that trend line and get crushed. That's charts for you. Now, what the heck was going on here? Well, interestingly enough, when the Fed is a little bit more dovish, the dollar should decline, okay, and yields should go down. We'll take a look at what yields did here. And let's go to the dollar. Okay, so the dollar on the daily chart yesterday, was actually rallying. Initially it was weak, and then it had a big green candle to the upside. The 10-year yield, let's take a look at the 10-year yield here. The 10-year yield, interestingly enough, had a big update yesterday. So as this is happening, I'm like, and this is live. I mean, like, I'm on the live day trading room with In the Money Stocks members. We're trading charts, we're making money here and there. And I'm like, this doesn't make sense. Markets are opening up here, but the dollar's rallying and yields are rallying. So what the heck is going on? All of a sudden, the markets begin to reverse. Now, again, it comes right off of the trend line. But why the heck did we sell off? And the answer is this. There was a rumor that ultimately panned out to be semi-true, that the Bank of Japan was going to cease their yield curve control. What's YCC? You're going to hear that a lot. YCC, yield curve control. Now, the YCC basically means this. It means that Japan for decades has basically pegged their interest rate to zero. And that's been fine because they've had no inflation. In fact, they've been in deflation for a large chunk of that. So they don't need to raise interest rates. Well, guess what? The inflation bug is hitting Japan now, and it's hitting it hard. So all of a sudden, they're saying, okay, we can't control this. We have to let interest rates go up. So the rumor was they were going to cease control, let interest rates float up, and then all of a sudden that screws with the whole yen carry trade, all of this stuff. Everything our financial system is based on with Japan and the inner workings of all the economies goes haywire. So the markets collapsed into the end of the day. Now, this is very interesting here. We got the Japanese central bank came out about midnight last night, East Coast time, and said, yes, we are going to let a little bit more interest rates float, but only to 1%. So again, here we are where, okay, that's fine and dandy, but now we've had a little rally back because it's not letting all hell break loose with the Japanese central bank letting interest rates for their economy float willy-nilly. It's that they're doing it very gradually. And that, again, is giving confidence that the yen carry trade is okay, that other things are okay, that it's not going to go haywire here. So we see the futures up about $3 today on the spiders.